Hello and welcome to The Bottom Line on TVP World. This is where we unpack some of the main business and economic stories of the day. I'm your host, Marie Kato. Somewhat unsurprisingly, today Hungary announced its decision to carry on with its interest rates unchanged at 6.5% for a seventh consecutive month. Along with Romania, Hungary retains the highest interest rates in Europe. On top of that, on Wednesday this week, we expect to hear the GDP results for the first quarter of 2025 for both Hungary and the Czech Republic. This will give us some insight into how our region is doing so far this year. Let's go to Jan Kennedy's feature for more.
The Hungarian Central Bank has once again opted to keep interest rates unchanged in April, marking the seventh consecutive month of stability. Standing at 6.5%, Hungary's borrowing costs remain the highest in the EU, tied with Romania.
In the Council's view, maintaining tight monetary conditions is justified in the current volatile environment. This also means the base rate may remain at its current level for an extended period.
The decision comes despite a drop in inflation, which fell by nearly 1 percentage point to 4.7% in March. However, it remains well above the central bank's 3% target.
There is no pressure for Hungarian Central Bank to decrease or lower interest rates because of this quite palpable and visible inflationary pressure. And there is also uncertainty stemming from abroad, from the possible huge tariff war, United States, China.
Tuesday's central bank decision comes just one day before the highly anticipated release of GDP figures, both for the Czech Republic and Hungary. According to the latest forecast from ING Bank, Hungary's economic growth is expected to be just 0.3% in the first quarter and 1.9% for the whole year. The Czech Republic, on the other hand, is predicted to grow by 2% in Q1 and by 2.1% overall in 2025.
There is political uncertainty in Hungary, more debt of this country compared to Czech Republic, higher inflation, which is really decreasing the real incomes of Hungarian households, and it's a limiting factor for the household consumption. So, to be general, Hungarian economy is in bad shape.
While first quarter forecasts are broadly in line with recent projections, as tariffs have not yet had a significant impact, Trinity Bank warns that if tariff threats materialize, the second half of the year could paint a different picture.
We expect now for the Czech Republic to grow this year only 1 to 0.7%, and for Hungary 1 to 0.8%, which is lower than was our previous forecast. And we see a huge downside risk. So we may go further in the downward direction, both in Czech Republic and in Hungary.
As CEE's largest economy, Poland may fare better thanks to higher domestic demand and lower dependence on global trade compared to other countries in the region. ING projects the country to grow by 3.2% in 2025, though Polish Finance Minister Andrzej Domański is more optimistic.
We forecast 3.9% GDP growth this year. Having said that, we also see some downside risk to this forecast, mainly because of rising trade tension.
Poland's economy is expected to grow slightly above 3% in the first quarter, with official results due in mid-May.
So tomorrow we will hear the quarter one GDP results for 2025 for the Czech Republic and Hungary. And early next month, Poland will announce its decisions regarding interest rates, and the first quarter GDP results will be announced as well. So with Tuesday's announcement of Hungary's unchanged interest rates and Wednesday's upcoming GDP results for Hungary and the Czech Republic, we begin to compile an idea of the economic impact of 2025 upon our region. And for further insight, we are now joined from Vienna by Katarzyna Rzentarzewska, Chief Central and Eastern European Macro Analyst from Erste Group. Hello, and thank you very much for joining us today.
Good afternoon.
So I first wanted to talk about the interest rates announced by Hungary's central bank today. They were kept at 6.5%. 20 economists polled by Bloomberg were expecting this result. So in many ways, it is not a surprise. I wanted to ask you whether the reason behind this decision this month is the same as for previous months, whether perhaps the trade tensions that we see have been experiencing in Europe have perhaps driven this decision this time.
So the situation in Hungary has not changed much over the last couple of months. Inflation has eased marginally recently, but still remains above the central bank target. So that's one factor affecting the decision of the Hungarian central bank. The other is that the Hungarian forint remains relatively weak. It has been holding above 400 quite visibly for the last couple of months. So the central bank prefers to remain cautious. This is justified in our view. Now the global uncertainty only adds to the fragility of the situation of the Hungarian economy. And what has actually changed that the fact that the tariffs were announced and now are at 10% for the whole Eurozone, obviously adds to that uncertainty. We still don't know whether they will be sustained further in the second half of the year or the situation will change. Then it will have also impact on inflation. In short term, we see some deflationary effects stemming mostly from the commodity prices. So that's something that may help inflation to go down, but in the medium term, we may see quite opposite effects. So taking this into account and focusing more on the future developments, Hungarian Central Bank announced today clearly that they prefer to keep the interest rate stable for a longer period of time. So I don't think that the situation will change anytime soon, given the uncertainty.
The governor of Hungary's central bank, Mihály Varga, who was actually appointed not so long ago in March, he emphasizes that the country actually needs to pursue, as he said, a disciplined and patient monetary policy due to the intensifying geopolitical tensions that have increased risks. Would you be able to tell us about what risks he is referring to and perhaps what kind of monetary policy he would like to pursue to address those risks and what needs Hungary needs to address?
So Hungarian is very sensitive and fragile regarding the market uncertainty, the assessment of the investors of the market. So when we see, for example, when the Trump tariffs were announced at the early April, we saw a VIX index skyrocketing to quite high levels. So this kind of volatility doesn't help the Hungarian forint, who in our view is actually one of the most sensitive currency regarding the so-called risk-averse approach or risk-on mode. So whenever the risk increases on the financial markets, the Hungarian forint and Hungarian currency is really vulnerable. So that's the one thing. On the other hand, we still do not know what kind of tariffs we will have, how it will impact the growth, to what extent the Hungarian economy will sustain a positive growth rates and expansion. And obviously, still, we don't know what will happen to inflation. This uncertainty is mainly the source of the concern for the Hungarian Central Bank and obviously also to us. So at this point, all these concerns are really justified and making this decision of having stability of rates really a good one to see what's going to happen to move forward.
I wanted to talk a little bit about Hungary's inflation, if we could just bring up a visual with the latest data. So we know that inflation is at 4.7%, and it's still off that 3% target that the Hungarian Central Bank is after. It has been going down, but it's still too high. How do you view the current situation in Hungary, and how do you think that that will impact the downward trend if it continues in that direction?
So definitely weak growth is deflationary in its nature. So if there are not that many consumption spending, the household sentiments remains weak, and we do not see a very dynamic private consumption growth, this will be seen in kind of deflationary pressures. In Hungary, situation is also a bit more complicated to assess because there are many regulations that affect the inflation development, and Prime Minister Orban, ahead of the parliamentary elections that will take place only in 2026, but is already announcing some measures that should keep the inflation down. Our forecast is that Hungarian inflation on average will be around 5% this year. So we do not expect any major downward trend to happen. Now, a bit commodity prices and a drop of commodity prices, especially oil prices, will help with a downward trend of inflation. But in general, we think that inflation will remain elevated.
Okay, I wanted to now move on to the GDP results that we await tomorrow, both for Hungary and the Czech Republic. If we could just bring up a visual with the forecast for both the Czech Republic and Hungary. So tomorrow, we expect the results for the first quarter of this year. I wanted to ask what you at Erste Group are expecting to hear, and what that actually what you expect those results to reflect in terms of the trade tensions and the geopolitical tensions that we've been experiencing in our region so far this year.
So regarding Czech Republic and Hungary, our forecasts are quite similar. So for Czechia, we expect around 2% growth year on year in the first quarter, and in Hungary around 0.4, 0.5 maximum. The first quarter is quite difficult to assess because it's still a pre-tariff announcement. So we have to remember that Trump's tariffs were announced only in April, and that comes in the second quarter. In the first quarter, we may see such effects as like pre-stocking. So if the exports will grow quite dynamically, because all the companies expect the tariffs to happen later on, so let's say in second quarter, then they will try to build the inventories as much as they can. So that may be one factor that impacts the first quarter. And first quarter may actually not be a representative for what's going to happen in the whole year. Obviously, we have seen such a positive announcements like fiscal expansion in Germany. We have seen market sentiment actually lifting after these announcements. And only now in April, we see some decline of the market sentiment and how the future is seen. So the first quarter, our forecasts are similar, but we do not take it as a representative for the whole year. We still think that the assessment of the tariffs will come only later, so second quarter and in the second half of the year, and we still think that the impact will be negative. So in the first quarter, lots of things are happening, as I mentioned. Pre-stocking, building inventories, so the export growth may also inflate the growth upward, while in the remainder of the year, only the true picture will reveal how the tariffs impact the CE economies.
Absolutely. And I wanted to ask, bringing what you forecast at Erste Group, if you could just bring that into how you might see that in comparison to Poland, and how the impact of the tariffs might materialize in our region, with the knowledge that obviously, like you said, the impact will materialize later on in the year. But with the knowledge that you have so far, what are your thoughts?
In response to the announcement of the tariffs, we have lowered our GDP forecast for 2025 and 2026. This revision downward was not extensive one, maximum 0.3, 0.5 percentage points, so rather marginal. It's also because this negative impact of the tariffs we expect to be mitigated to some extent by this fiscal expansion in Germany. Although it has a different character, more domestic, but we still expect some positive spillover effect. So there are like two forces going. One way, there is a fiscal expansion in Germany and expected improvement. On the other hand, we have seen the tariffs. Our baseline scenario that is reflected in our forecasts assumes that we will see 10% tariffs throughout the remainder of the year, so that this, let's say, pause that we see now will be maintained in terms of level of tariffs. So in general, within the region, we see Slovakia, Hungary, and Czechia as most exposed to the direct negative impact of tariffs. And then the indirect impact will affect the whole region. Poland, in these terms, because it's relatively closed economy compared to Slovakia, Hungary, or Czechia, and not oriented to that extent to the automotive sector, will see much lower negative impact. Our forecast for Poland for this year is close to 3%, so we are slightly more kind of cautious and pessimistic than what has been mentioned by Ministry of Finance. We think that a lot of growth in investment has actually already materialized. Obviously, it will accelerate, but we remain more cautious. We also think that the consumers may not be as strong as expected. The consumer confidence actually has been slightly falling across the region. So that's something what makes us worry looking ahead of the future. And we remain on the more kind of cautious side, seeing Polish growth around 3% in 2025 and around 3% in the first quarter of 2025 as well.
So I just wanted to confirm, so Polish Finance Minister Andrzej Domański still sticks to his optimistic level of 3.9%, and at Erste Group you are suggesting 3% GDP growth for 2025?
We are more cautious. It's slightly above 3, but yeah, close to 3.
I just wanted to ask, as we wrap up, how do you assess the tensions, trade and otherwise, that Europe is experiencing with the US? Do you think that there is a chance that some negotiations might emerge before we hear any further news in terms of the tariff increases?
Well, any negotiations and any kind of possibility to kind of lower the tariffs and work on some compromise will be seen from our perspective as a good and positive news. If it's happening, and I can only hope that this is happening, then obviously we would welcome that. It would definitely give for the sentiment, remove a lot of uncertainty. You know, you don't need high tariffs to be in place in order to dampen the growth. The uncertainty that has been with us since the election of the US president has already negatively impacted the growth outlook and made the investments being held off. Therefore, anything that is a good news and brings a hope that the production can be restarted, that the exports will happen, will be positive for the region.
I remember in our previous conversations, you were quite optimistic about the Polish economy and the protectionist policies that President Trump was going to implement. Would you say that you are a little bit less optimistic now?
Well, relative to the region, we are still optimistic about Poland, right? So it's all from the relative point of view. So growth in Poland is expected to be around 3%, which is still one of the highest we expect for the region this year. Romania will do much weaker, around 2%. Also Czechia or Hungary, Slovakia below 2%, between around 1.5%. So Poland in this term still stands out, but obviously the risks to the downside are mounting. I think that the initial announcements of 20% tariffs came as very unexpected. We have seen a very strong reaction on the market. And if such scenario happens, like this is an adverse scenario for us, but if this materializes, then obviously we will be lowering our forecasts further. But relatively to other CEE countries, we are still very positive on Poland.
Okay, Katarzyna Rzentarzewska, Chief Macro Analyst for the Central and Eastern European region at Erste Group. Thank you so much for joining us today.
Thank you.
And that concludes The Bottom Line for today. I was your host, Marie Kato. We're on every weekday at 5:10 CET on TVP World. And in the meantime, for the latest in regional business, follow us on X and on tvpworld.com. And for more news and analysis, stay with us on TVP World. Goodbye.